The Federal Reserve has decided to keep its benchmark interest rate steady at 3.5 to 3.75% in late January 2026, marking a pause after several rate cuts throughout 2025. This move comes even as the S&P 500 continues to hover at record highs above 7,000, signaling investor optimism despite ongoing economic uncertainty. Persistent inflation remains a concern for policymakers, with core inflation reported at 2.6% and headline inflation slightly higher at 2.7%, both sitting above the Fed's 2% target. At the same time, the job market is showing signs of weakness, adding complexity to the central bank's decision-making process. Early February market reports describe this policy pause as the Fed's shift away from an emergency support stance and into a more cautious, watchful phase. The central bank's balancing act aims to prevent inflation from spiraling while not derailing the economic recovery by tightening too soon. Adding to the market's recent jitters, the S&P 500 dropped by 2.1% on January 20, following new tariff threats that rattled traders and everyday investors alike. The Fed's decision to hold rates steady is now forcing investors to rethink their strategies amid signals that the era of easy money may be over.